Today we're going to talk about catastrophic risk. It's hurricane season, so I think it's a good time to go over what you should be looking at in terms of how you've purchased your insurance and what it would cover, and some items which you may not be familiar with that will be very helpful for you to do as a checklist on a review basis. So let's just hop right into it. There are only three perils that can cause major damage across a wide swath of terrain and assets within that area. Those are wind, flood, and earthquake. Therefore, we're going to chat about each one of those, how they relate to your insurance, and how your insurance protects you, and or you might want to modify so it does a better job of protecting you in those circumstances. In the case of wind is simply what it says. It causes and can cause damage. When it reaches a named storm status, then things change because it now becomes either a hurricane or a tropical storm, which is named, and that has a completely different area of cover within your policy. It affects your deductible. It affects your limits. So to be clear, you need to distinguish, first off, if you suffer damage, was it caused by just simply wind or a named storm? But I'd like to drop back for a minute. Before you purchase your property insurance, which is your major protection against these perils, you need to understand where your exposures are, so that some of that's pretty easy, right? If you have a hotel on a beach, it's very likely that you have an exposure to wind and flood, maybe not earthquake, but that's well known. There are, and also your concentration of assets, where they may be within various regions, such as coastal areas or areas in ports. And to understand that, FEMA has an excellent website which will detail the wind areas as well as flood zones, which is very popular for people to look up, but also earthquake. So the government database is quite extensive, and if you find that your assets are in these areas, then you need to review what kind of limits that you're going to want across those assets within that region. So if you're a major retailer and you have 300 stores and they're all located up and down the coastal areas, you can then add up that asset value that could potentially be impacted by a major storm, and those are the limits that you may want to insure to. If there's great distances between them, then you might consider less limits, but always err on the side of, in my opinion, not being the one that said, I didn't buy enough, I had a $30 million loss and I only have a $20 million limit. So after you understand your exposure to those areas, that's true, by the way, of flood and earthquake, and you've decided on what limits that you feel are appropriate for the assets located there, then you need to understand how your insurance policy is going to respond and what triggers are going to cause that section of the policy to provide cover. And there's a lot of misnomers, and some of that is just simply because there's a just words that we normally use in typical conversation, but they may not be appropriate within the insurance world or risk transfer area. So let's start with it. First, if you have a hurricane, then you need to look at your policy to see where the damage occurred. Let me just drop back here. You need to understand how the deductible is going to respond within that named storm area. If your property is located in Tier 1 or Tier 2, oftentimes your policy will have a completely different deductible. The percentage may go up, so the percentage could be 2% of the value, it could be 5% of the value, it could be a fixed dollar. It could be on a per occurrence basis, or it could be per location. All of those have a dramatic impact on how much you're going to be paid. Also, if you have a lot of smaller values scattered and you have a per location percentage, then you may not even have coverage if the deductible also has a minimum. Sometimes that minimum could be $100,000, could be $250,000, could be $500,000. We've reviewed policies that they were paying a significant amount of money, but yet their assets were not that significant, and they had not just a percentage, but they also had a minimum to each property for that exposure. And after you looked at it, you said, well, what am I really covering if I have a $250,000 or $500,000 retention and my property is only $750,000? I'm really not buying all that much because it's unlikely the whole place is going to be destroyed. Therefore, I'm spending money for, frankly, very little value. That, of course, works in reverse. Oftentimes, there's coverages that we look at where there are a major concentration and they don't understand that they have a sublimit on flood or a sublimit on wind and or quake, which is significantly lower than their largest single location, and also and much lower when you consider the concentration in that area. So you really need to look at that and understand how your deductible is going to respond, and we'll talk about that in a little bit. Accompanying wind often is rain. So there's also an area where people get a little confused with wind-driven rain or water damage and flood. So let's be clear. A flood is a breaking a boundary of water, which means the river overflows its bank, the ocean goes over its beachhead. It is not, under pure definition, water that comes in from the street. That's not a flood. It may be backup of sewer and drains, which is different, and backup of sewer and drains may be included within your flood definition, but typically people, even when they have a pipe burst, say, oh, I have a flood. You don't. You have water damage. Water damage oftentimes has a much lower deductible than flood. With respects to how you determine that, you look at the definition, which is very important within your policy, because oftentimes backup of sewer and drains, which is what causes inundation into a lot of areas that rains 6 inches in an hour, the water can't drain off soon enough into the sewers, and therefore it backs up, it overflows, and it inundates an area where you may be in a lower lying area, which may not be a flood zone, but it just simply, because over time they've developed the area over a number of years, and now there's no more area to absorb the water, and you end up with significant water damage. If that's not included within the definition of flood, yet it stands outside, then you most likely have a much lower retention, and therefore don't let the adjuster put that deductible of flood where you may have it different. You may have it differently positioned in the policy. It's critical because I have seen companies report losses as floods. It gets transmitted in that way, and it goes right through the process. And unfortunately, they don't really get the money that they should be getting or the full amount. So be very careful on how you define what your definitions are. In terms of earthquake is, you know, you don't need a great definition for it. It is, you know, it's fairly self-explanatory. But what most people don't realize is many areas are in earthquake zones which you may not think about. So I encourage, it's just not in California. So I encourage all to, when you're looking at your asset values, to look at and pull up those FEMA maps which show earthquake activity and earthquake maps. The New Madrid zone, which is in the central United States, there's even earthquake zones in and around New York and on the East Coast. So are they prevalent? No. Will you probably have to pay a lot more money for it? No. But you should not accept a lower limit, especially if you're in an area which is not prevalent. And be mindful that both flood and earthquake are aggregates, meaning that if you have a limit for flood in your policy, it's typically aggregated. So you may have a $10 million limit or a $20 million limit. It's aggregated. So if you incur a flood in March that damages $10 million of your values, you have another flood in early May, which damages $15 million, and you have a $20 million limit, you are going to be out $5 million because it's not per occurrence, they all add up. And the same is true for earthquake. So be very mindful of that. Those two coverages are aggregated, and you need to recognize that against your exposures. Wind typically is unaggregated, so that if there's a windstorm or a hurricane and you get hit in September, or and then another one, and then another one, those same limits will apply, you know, to each and every one. Of course, you need to be mindful that every insurance policy has a cancellation clause, and I always get asked the question, well, I have a year policy, and I say technically your policy is only as long as your cancellation clause, for which I get a surprise. Well, what do you mean by that? I said, well, if you look at your policy, it has a 60-day or 90-day, sometimes 30-day cancellation clause, which means the insurance company can issue you notice and be off risk. And likewise, you can cancel them, except that you end up paying a short rate penalty. So if there's a number of claims that do happen, you even though it may be a per occurrence, you may find a notice in your mailbox, which is the reason why you always want to have a backup plan, if you will, or a backup insurer just in case. When you're reviewing your values, there are a number of ways you can treat the exposure. The first way, of course, is property insurance, which means your general property carrier can insure wind, flood, and earthquake. And they may be sublimited, but they can accept those coverages. The second way is if you're in certain zones, where maybe in Florida or others, where the insurers simply do not want to provide coverage in that area, you will have to buy a specific standalone cover. And you also can do that whether it's offered by the state or whether it's offered by what we call specialty insurers that will only insure those coverages. Usually they come in a package. Usually it's flood and quake. So those are, you can buy it specifically. And the third way, and not often used because it needs to have a link, is you can obtain wind, flood, and earthquake via a marine policy, and it's called a stock throughput. So you can, if you have ocean marine exposure, you can add to that inventory that is stored stateside, and it could be in very prone areas for wind or for flood or for earthquake. And in fact, usually they will provide much higher limits, lower retentions, and less exclusions. But you do have to have that link of that exposure. And it's a way of mitigating risk, and also could be less expensive. There is a catch, however, and that catch is that you will not get any business interruption from that policy. You will get a selling price or a cost plus on the inventory, but if you turn your inventory more than that one time and you're out longer, you will not get that business interruption. So you have to purchase that within your property policy and dovetail the two, and therefore you'll have two distinct different deductibles, but it may be worth it in the end if you're evaluating the costs and the limits of cover. I hope that I've been able to enlighten any of you listening to this. There are other areas which you need to think about when a loss occurs. Some of these key questions are: one, when you have civil authority, which is in most property policies, civil authority says, okay, the government or the authority says you need to leave. The flood is coming or the storm is coming and you have to go. And therefore you have to leave your business and you can't operate. You generally have 2 weeks to 30 days coverage for that loss of income during that period under your civil authority cover. And to be clear, there's usually a retention with that, a time deductible. And then the question always comes, well, when is it triggered? A lot of times, good corporate citizens have their employees leave long before or shut down their businesses long before the civil authority declares it a state of emergency and you have to get out. And they believe that the policy should respond from the day that they made that decision. The fact is that's not what happens. The insurance company is going to start that time deductible from the time that it was issued by the authority. So you really need to understand that. Also, coupled with wind, oftentimes is loss of power. So it's called off-premise power failure, meaning that the electricity or supplies, gas, electric, whatever it is that runs your business, stops because damage has occurred outside, transmission lines have come down, we'll talk about that in a minute, and therefore you have off-premise power interruption, and because your facility, even though your facility may not be damaged, you can't operate because the power is out. That also has a time deductible, so you have to be mindful of when that power went out and also what caused the power to go out, because it has to fit within that trigger within the policy. In addition to that, oftentimes within off-premise power coverage, they exclude overhead transmission lines. So if the trees fall on the overhead transmission lines and the transmission line comes down and that's what causes your power not to be supplied, they're not going to cover that loss of business interruption. So what you need to do is try to get overhead transmission lines covered. And if they say no, then try to get within a mile or 5 statute miles of your facility. It's sort of a secondary negotiation, but it will also be very beneficial if it happens. Now, there are some areas, of course, where you don't have overhead transmission lines, typically in cities like New York City. It's not terribly critical in that area. Also, when you're viewing your off-premise power definitions of what coverages, make certain that you include within that your data lines, right? So that even though you may have power, they may have your data lines or your cable lines may have been damaged and not your actual electric power lines. Therefore, you still can't run your business because now you don't have internet, you don't have anything else. So again, be very mindful and careful of the definitions and how broad they should be so that you're properly covered. Naturally, if you have any kind of refrigeration or temperature control storage, it's even more critical because you end up with spoilage. So again, understand those coverages and how they get triggered and the limits for them. Oftentimes, all of these are sublimited, so please look at those sublimits, and if you need to increase them, then you should think about that and get the costs accordingly and weigh it. Well, thank you for joining me on this podcast. I hope this was informative. I always like to say everyone should know when is a flood not a flood, when is a windstorm not a hurricane, and how that all applies. So if there are any questions, obviously, our firm is here to assist and help. And I hope you turn into our next podcast, which will be informative. Thank you very much.